Hello everyone, my name is Mark Newman. Today I want to take you through what happens for taxation purposes when we sell a rental property that previously we've been claiming depreciation on. A lot of people aren't aware that when you claim depreciation on a rental property, that this reduces its cost base, i.e. its value for taxation when we sell the property. Sadly, over the years I've met a lot of people who've made a poor investment in their investment property. For example, they bought it and then they sell it years later for exactly the same amount. By enabling them to sell it for the same amount, they can pay out their loans and they think they're debt free. Unfortunately, as they've been claiming depreciation, there's a taxation adjustment and they often end up with a taxation bill. So how does this work? So let's say we originally purchased the property for $500,000. We then organise a depreciation report through BMT or someone else, and that shows that we can claim depreciation of $10,000. So we therefore claim the depreciation as an expense in our taxation return. Assuming our tax rate is 32.5%, that will either reduce our tax or give us a refund of $3,250. Now, if we own the property for 10 years, over that period of time, we'll claim $100,000 of depreciation, but also have taxation refunds in total of $32,500, a substantial amount. But for taxation purposes, our property is now worth the $500,000 we paid for it, less the depreciation we've claimed is $400,000 for taxation purposes. So let's say we managed to sell it for what we paid for it for $500,000. So a sale of $500,000 means that for tax purposes, we have a $100,000 capital gain. As we've owned the property for more than 12 months, we reduce that by half, which is a $50,000 taxable capital gain. So if our tax rate is still 32.5%, we will pay taxation of $16,125. That will be our tax bill on sale. And this is what catches a lot of people out, that they're not aware that they've had the benefit over the years or they've forgotten about it. Therefore, there's a taxation adjustment at the end. Now, let's say they waited till they retired and had no other income. If they only had income of $50,000 in a tax return, currently that will result in a taxation bill of about $9,000. So yes, whilst it is a bit of a sting in the tail of selling the investment property, we've had the benefit over the years, so the depreciation report is definitely worth doing. But what we have to do is make sure that we're aware that we're reducing the property's value, so that at the end, we will have that catch up. If you have any questions about how depreciation on property works, please do not hesitate to reach out. Thank you, Mark Newman.